All right, let's jump right in. If you've ever looked at the world of American finance and just felt totally overwhelmed by all the different regulators, trust me, you are not alone. So today, we're going to tackle this thing head on. We're on a mission to decode what really feels like an impossible puzzle, the U.S. financial regulatory system.
And that really brings us to the big question, right? Why is it such a complicated alphabet soup? I mean, you've got the Fed, the OCC, the FDIC, the SEC. The list just goes on and on. Why isn't there just one big agency in charge of it all? Well, the answer is actually buried deep in American history. And believe me, it has huge implications for how your money is handled today.
You'll often hear this structure called the tripartite system, and that's just a fancy word for three parts. This famously fragmented approach is what makes the U.S. financial system so unique and so different from pretty much every other major economy out there.
And this slide really puts it in perspective. On one hand, you have the American puzzle, this tangled web of federal, state, and even industry groups with overlapping jobs. But then you look at places like the UK or Australia, and they use a much cleaner Twin Peaks model. Basically, one regulator for stability, another for how companies behave. Simple. The US system? Yeah, not so much.
So to make any sense of this puzzle, we have to start by understanding that three-part power structure. Let's break down the basic blueprint of the whole system. Think of this as the mental map you're going to need to follow along.
And here they are, the three layers. You've got the big federal regulators at the top. Then you have individual state regulators, and finally this really unique thing called SROs, which are basically industry groups that regulate themselves. This whole setup grew out of this historical tug-of-war between federal power and states' rights. Now for today, we're going to focus mostly on that first, most powerful layer, the federal agencies.
Okay, so let's dive into that top layer, the federal regulators. This is where we finally get to meet the key players and start to really decode that infamous alphabet soup.
First up, you've got the big one, the Federal Reserve, or as everyone calls it, the Fed. It was set up way back in 1913, and it's our nation's central bank. Honestly, it's the backbone of the entire system. When you hear about interest rates going up or down on the news, that's them. But trust me, their job is so much bigger than just that.
In fact, the Fed is juggling 5 massive jobs all at once. It sets monetary policy, that's the interest rate stuff, to keep the economy humming. It's the ultimate watchdog looking for huge risks that could crash the whole system. It supervises some of the biggest banks, makes sure our payment systems actually work, and of course, it works to protect consumers. Its influence is just huge. And here's something you might not know. The Fed isn't just one building in Washington, D.C. Nope, it's actually a network of 12 regional Federal Reserve banks spread all across the country, from Boston to San Francisco. This design is supposed to make sure that the economic reality from every corner of the nation is actually heard when those big decisions are made.
Okay, next up in our alphabet soup is the OCC. Here's a simple trick. If a bank has National, or NA, in its name, think Bank of America, NA, then the OCC is its main boss. They're the ones who give a bank the license or charter to operate across the country, and they make sure it's following the rules.
Then we have the FDIC, and this agency has a really powerful origin story. It was literally born from the ashes of the Great Depression, a time when thousands of banks failed and people lost everything. So its core mission is simple, but it is absolutely profound. Make sure you never, ever have to worry about that happening again. And they do it with this number. This might just be the most famous number in all of U.S. banking. The FDIC insures your deposits for up to $250,000. That single guarantee is the bedrock of our confidence in the banking system.
But get this, here's a little fun fact for you. When the FDIC first started back in 1934, the insurance limit was just $2,500. Today's coverage is 100 times bigger. It's a safety net that's had to grow right alongside the economy. Okay, so let's shift gears from banking to investments. Here, we meet the SEC. Think of it this way. If the FDIC protects the money in your bank account, the SEC is the watchdog for your investments. It oversees public companies, the stock exchanges, all of it, to make sure the markets are fair and transparent for everybody.
And right alongside the SEC, you have the CFTC. These guys handle the super complex world of derivatives, things like futures and options. For a really long time, these two agencies kind of stayed in their own lanes, but as we're about to see, that is changing fast, and it's kicking off some major fights.
So this brings us to a really crucial point.
Who regulates your bank all depends on its charter. This is what's known as the dual banking system in action. Just look at the table. A national bank like Citibank, it's supervised by the OCC. But a state-chartered bank like Ally Bank, which is based in Utah, has both the state of Utah and the FDIC as its primary regulators. It's this choice of charter that creates so much of the complexity.
So we've met the main players. Now let's zoom back out and ask the most important question of all. Why does any of this matter to you? Well, the answer lies in the overlaps, the conflicts, and how this old system is trying to keep up with the future of finance. You see, a huge consequence of having all these different pieces is what people in the industry call turf wars. With so many agencies, their jobs and responsibilities often overlap. And this can lead to regulators literally fighting over who gets to be in charge, which creates a ton of uncertainty, and sometimes means important things just fall right through the cracks. And if you want the perfect example of a modern-day turf war happening right now, look no further than crypto. Is a digital coin a security, which would put it under the SEC's control? Or is it a commodity, which would hand the reins to the CFTC? This one question has started a massive regulatory battle in Washington with billions of dollars on the line, and we still don't have a clear answer.
And it's not just crypto. Financial technology, or fintech, is putting enormous pressure on this entire system. For a new company, trying to get licenses in all 50 states is incredibly slow and super expensive. And this has kicked off this huge debate about whether we need a totally new, streamlined national charter just for these fintech firms so they can innovate faster.
So, after all that, what's the big takeaway? Look, the American financial system is complicated, and it's complicated by design. But knowing who regulates what, really understanding the pieces of this puzzle, isn't just some academic exercise. It is the essential first step to navigating the world of finance with confidence, whether you're an investor, working in the industry, or just trying to understand what's going on.
And that leaves us with one final big question to chew on. This system we have was built piece by piece over the last 100 years, usually reacting to a crisis. But in a world of digital currencies and instant global transactions, is this 20th century puzzle still the right design for the incredible challenges of the 21st?